Did it again. I think I updated the dumb thing. Hey, Brett Swarts here, founder of Capital Gains Tax Solutions. In this video, we are covering Opportunity Zone funds versus the Deferred Sales Trust and why you might do one versus the other. So Opportunity Zone funds are a great way to defer capital gains tax for a short period of time and to eliminate some capital gains tax over a longer period of time. The main disadvantage would be typically you need to hold it for more than 10 years and into these funds. And these funds are illiquid places, typically real estate developments and underserved areas that the government has deemed appropriate to increase the opportunity for people to put capital gains tax equity or gains or capital into these funds to get some good treatment. And so the first, way to clarify this would be that the deferred sales trust and opportunity zones, they work for just about any asset, right? So in fact, I don't know for any asset that it doesn't work for. So whether it be stock, whether it be crypto gains, whether it be property or a business sale, you have the opportunity to use the opportunity zone or deferred sales trust. Unlike a 1031 exchange, it has to be only investment like property, and so you definitely have an advantage looking at the opportunity zone funds and a deferred sales trust when it comes to the asset, any asset that you're selling. Now, we do sometimes get a question about whether or not you should use a deferred sales trust versus an opportunity zone. And I think it really kind of depends on how entrepreneurial you want to be. We love the deferred sales trust for a number of reasons. One of the number one ways you could be passive or active, meaning you can be an active GP or you can be a passive LP. You can retire or you can be an entrepreneur. Whereas opportunity zone funds, unless you're the GP who's running the opportunity zone fund, you're going to be a passive investor. And the other thing about that is they're typically illiquid assets. I mean, you're building something, right? That's part of what the requirement for the opportunity is typically land or a redevelopment of a property. And so by nature, the investment is illiquid, whereas the deferred sales trust, you can put it all into liquid investments. And then that enables you to practice what's called optimal timing, which is probably the biggest downside to the opportunity zone, is that once you're tied up with a deal long-term, you don't have the ability to practice what's called optimal timing. It's the same reason why 1031 exchanges aren't great, and that you have the 45 days to identify and 180 days to close. So you're selling high and buying higher in a short period of time, right? Which is the opposite of what our parents taught us to do, which was to sell high and buy low. So the opportunity zone, it's almost like you're locking up your capital for a 10-year term. Now, that being said, they do allow you just to put the gain in there. And so depending on your basis, so what you're selling, you may be able to keep some of your basis. And so it's kind of a hybrid 1031 jail in the sense that you have some timing restrictions, you have some tie-up, you're getting tied up. So, but you do have some, depending on your basis, you might be able to pull a little bit out. And so the deferred sales trust, on the other hand, you can keep it 100% liquid in investment grade securities and put it in the bank. And then you can also, again, put it into passive or active real estate. You can do it with you as an active GP or as a passive LP. It's a great way, or the trust could be the passive LP. You would just be the note holder, right? That's part of the difference is you're changing the characteristic, which is oftentimes why people ask us, like, how does the deferred sales trust work in that sense? Well, understand that you're wearing a different hat. That hat being a lender, right, versus an owner. Whereas in a 1031 exchange or opportunity zone, you are an owner of the equity, right? And you're rolling it over into a fund, or you're rolling over into another investment property. And so you have that ownership hat, and that's why you have all of those restrictions. Whereas if you can move into a lender characteristic, then you have much more flexibility, which then of course leads into the ability to partner with the trust and buy other deals and be active again. So really the answer to this video, should I use an opportunity zone or should I use a deferred sales trust, is it all depends. It depends what you're trying to accomplish. It depends on how quickly you want or need your money. It depends on how diversified you want to be too. Oftentimes the opportunity zone deals are just like one property in one location. Whereas the deferred sales trust can be, 30 properties, 100 properties, and or different businesses or different investment stocks to be able to diversify your investments. And so the last thing I'll touch on is opportunity zone funds as well as 1031 exchanges. They're really tied to just capital gains tax. Whereas the Deferred Sales Trust is tied to capital gains tax, but we also have what's called the Deferred Sales Trust Plus, which you can check out, which is tied to estate tax. It's eliminating estate tax liability, and that's a powerful way to also grow your wealth. Hey, if we can help you at all with any of what we're talking about here to make decisions on opportunity zones, 1031 exchanges, Deferred Sales Trust, donor advised funds, charitable remainder trust, Delaware statutory trust, we want to encourage you to go to capitalgainstaxsolutions.com and schedule a one-on-one time with us. Our minimum size deal is $1 million net proceeds, $1 million gain. And also check out the new book that's coming out, Building a Tax Deferred Exit Strategy. Hey, please rate, review, subscribe to the channel. We so appreciate everyone watching or hearing this on the podcast. And we will talk to everybody